What is good, boys? Welcome back to another video. I want to start it off very quick by saying, yes, most beginners do lose money when they start futures trading. And honestly, I think it's because of one simple reason, and that is entering a trade without having a set of a criteria or a set of rules behind it. Now, before I take any trade, I do run by a set of rules. It doesn't have to be an exact amount. It doesn't have to be every single rule. It doesn't have to be perfect, but I do follow them. And many times it helps me either win more or just prevent unnecessary losses. And these unnecessary losses do catch up when you are a beginner. So having a set of rules and having a set of criteria can help you a lot. So today for this video, I'm basically just gonna give you guys and show you guys a set of rules that I do follow myself, a set of criteria that I run through, maybe not to the T every time I take a trade, but it's a good basis, it's a good foundation that I genuinely think can help many of you guys, especially many beginners, when they start trading. Rule number one, at least to me, is there must be a draw on liquidity. Now, many times within trading, there are different terms, different ways to say what I'm trying to explain. But at least the way I trade, it's basically price has a point of interest. So to make it as simple as possible, you have these spiky points, let's say within the hourly or the 4 hour. Now, many times, why exactly? I'll go through that on another video. But many times, price, at least on the micro, tends to drive and go towards this specific area, this point of interest. So what I like to have, at least as a rule, is a point of interest, a draw on liquidity. So I'd like to relatively have it nearby, or at least something prominent and something that's basically screaming my name, basically saying, hey, I'm right here, I'm like 100 points away. Very simple, very straightforward. So what exactly is that? At least to me, that can be previous day high, previous day low, session highs and session lows, and something that I like personally a lot is unfilled gaps. So it can be unfilled daily gaps, which are a bit less recent, but more recent would be an unfilled 4 hour or an unfilled hourly. So that to me is honestly like very strong points of interest. And if that's nearby, or if that's something that it looks like price is going to, I'm definitely going to be encouraged within that setup. So let's say a setup, it's a long, right, towards previous day high, and previous day high is a very strong point in which it looks, I'm probably going to take it. Also with other rules, and which I'll be explaining as well. So if there really is no obvious, point of liquidity, point of interest, however you want to say it, there really is no clear purpose of where price is going to, at least to me, at least at the very moment. So yeah. Now, rule number two is structure must be clear, or at least relatively clear, and must be kind of moving towards that drawn liquidity. So, for example, you have previous day high, which is above price all the time. You have previous day high. What do you necessarily want, at least right before you take a trade, at least to me, is a continuous bullish structure towards previous day high. Very simple. If you're going to take a long when price is currently within bearish structure, there is a probability that price will not go your way. I mean, it's very simple. It's like the same, like super basic, trend is your friend. So respecting the current trend, at least in my opinion, I know other people trade different ways, but at least in my opinion, I'd rather take a trade that has a clear trend towards this point of liquidity, because to me, it's a higher probability of price going to this area if it's currently supporting bullish structure, for example, previous day high. So certain examples of structure, just to explain it to you if you're like a super beginner. Bullish structure, it's essentially a high, high, a low, a higher high, so a high that's higher than the previous high, and then a higher low. Very simple. So high, low, and so forth. That is bullish structure. That is bullish trend. The most clear and simple way possible to explain. And vice versa is bearish structure. All it means is you have a high, a low, a lower high, so that high does not go past the previous high, and then a lower low. Very simple, very straightforward, but like I said, a continuous trend in going to like this point of liquidity is, at least in my opinion, a very important role. I would say I am more of a continuation based trader, so that is kind of like the number one thing I'm looking for, really just clear trend. So if structure is like moving messy or just does not have a clear direction towards any point of liquidity, I would honestly say just stay out and wait till price does have that. Price is going to like move correctly. Once you see it moving correctly, boom, take a trade. But for now, sit it out. Now for rule number three, very important to me as well, is I need strong displacement and strong volume, especially towards these drawn liquidities. As you can see, draw on liquidity or just these point of interest are very important to me. It's kind of like the basis of what I trade. But a lot of these other rules in which I'm saying, they also align with it. So what exactly do I mean about like displacement or volume? Displacement really just means that price, whether it's institutional traders pumping in billions of dollars or just however you want to see it, price is moving a lot stronger, or there's a lot more movement necessarily, a lot more impulse within price. So what exactly do I mean by that? Let's say within the average 5 minute candle, you're moving up 5 points, for example. Now, starting market open, you see price on average is now moving within a 5 minute candle, let's say, it is now moving 15 points, and it's moving 15 points towards, again, previous day high. Now, what exactly does that mean to me? When I see a lot of volume, a lot of displacement towards a draw on liquidity, let's say a 15, 20 point candle when most candles prior were like 5 points, I'm going to assume that price is most likely or more likely to go to that draw, especially with that amount of volume. So it's basically just a tell of a higher probability that price is going to move towards that direction. So a very key idea, at least within this rule specifically, is that slow and really no volatile or no volume filled candles, or just price in general, isn't necessarily the best idea to take. I would wait for price to show that distorted displacement, to show that volume, at least the way I trade. Like I said, I trade with volume, draw on liquidity, and direction. So many times it won't happen right at market open, but let's say price ends up chopping for like 20 minutes, then out of nowhere, what happens? Buyers start coming in. So you see a lot of volume, a lot of displacement. Price just went up, let's say 30 points within like a second, or not a second, but like 20 seconds or 30 seconds or a minute. Price just went up X amount, which is larger than price has been moving within the last half an hour. Just took out all that resting liquidity essentially. Price will most likely continue towards whatever target there is. Now, rule number 4, at least to me, is I do not trade choppy or range-bound markets. At least within the micro, it's something that I don't take. Like I said, my trading style is more continuous-based, so seeing a range is just something I don't like, and if anything, decreases my probability of winning, so I rather just stay away completely from it. Now, what exactly is a range? It's basically, like I said, you have bullish structure and bearish structure. So if you don't have any of the two, and price just seems to be looking like a barcode, that is a range. It means price just going up, down, with no direction. There are no higher highs, higher lows. It's just within the same place. If you were to take a zoom in picture of it and it looks like a barcode, you are in a range. And at least to me, I am not taking that. I am not taking anything for that time being. Even if that means it's a whole day and which is just range bound, I'm most likely not going to take anything. Now, other traders might like it, supply and demand type traders or whatever, but at least to me, it's just something that's low probability, at least the way I trade. So I'd rather just stay out of it, not take anything, and just turn off my computer, to be honest. Very important is, at least within this rule, most beginners, a big reason why they're losing their trade is because they're trading within a range-bound market. A lot of traders don't know how to identify when price is chopping because they just see candles when they first start. So like I said, if you don't see any clear trend, whether it's bullish or bearish, and you're just looking at a barcode, just know that price is currently consolidating, and that's normal. Price tends to accumulate, manipulate, then distribute. So once you're in that accumulation phase, it's best not to take anything and just wait for price to manipulate. Now, lastly, rule number 5, the trade should be obvious. My personal rule is if I have to force a setup, if I'm looking at something and part of me does not like the trade, does not like the setup, then it's probably not a good setup. Many times when I'm looking at something, if it's screaming at me, like I said, if it's basically saying like this is something that I would take 10 out of 10 times, then I have to take it. But if it's something where I'm questioning my own ability of this trade or my own ability of like the setup essentially, then it's probably something I shouldn't take. If you're questioning the fact of whether this trade is good or bad, it's probably bad. It's probably bad, and I just wouldn't take it. And many times this has saved me, especially within this market now, like really within the last month or so. Price has been having certain days where it's been either good or it's just been really bad. And a lot of times when it's really bad, you kind of have these clear signs where you're like, okay, maybe I shouldn't take it because of X, Y, and Z. I'm looking at a setup, and a lot of times it does go through, but because of XYZ reason, maybe I shouldn't take it, and then I start questioning it. I'm like, you know what? It's one of those trades I'm just not going to take, and I think like half of the time, if not more, those trades just fail. So, and then I just end up there sitting in front of my computer happy I didn't take the trade. That's recently has been happening to me a lot. So if I were you, if the setup is not kind of like screaming at you, I just wouldn't take it. Remember, good trades usually stand out on the chart, so you really don't need to try to convince yourself whether or not this trade is good or bad, or whether you should take it. So if it's standing out, take it. If it doesn't and you're questioning yourself, just sit down. Don't do anything, and most of the time you'll be okay. Now, just to close off this video, I do want to say just most traders do end up losing because they don't follow these rules. Sometimes they see a choppy market and they take something. Sometimes they don't see a draw on liquidity and they take something. So if I were you, especially if you're a beginner, I would write this down within a notebook, quite literally, and before you take a setup, go through these set of rules, or even create a new set of rules for yourself, something that you believe would probably be more helpful, but at least write something down when you're a beginner. So when you're looking at a setup, you look at these rules, and if most boxes don't check, I just would not take the trade. It's the smartest thing you can do, and you can prevent so many losses, and if anything, win a lot more. So that'll be it for me. I just want to thank you guys for watching the video. I do have a Discord community server that I created not too long ago. I basically post my daily levels, market recaps, any information within day trading that I believe is very helpful, even free resources, whether it's technical or psychological. I post them there. I think it's super, super important. If anybody wants to learn, they should have a good set of resources. And many times, at least when you're starting, a lot of people say, you need to buy this, you need to purchase that, you need to get this course. If you're a beginner, I'd say the best thing you can do, at least when you're first starting and you just want to get a sort of glimpse of it, is use free resources. The internet is like a wonder in the sense of how many things you can get for free. I've gotten many things for free myself. So eventually, if you do want to pay for something, if you do want to pay for a mentorship, that is another thing in mind, which I do believe can help you a lot. But when you just want to get a glimpse of it and get some sort of foundation, look at YouTube. Look at all the videos that are out there. They have helped me so much. So I put a lot of videos within my server, a lot of free videos, no charge. It's not a course or anything like that. This is just a community that I want to grow, me personally. And yeah, so like I said, that'll be it for me. I should be posting this either tomorrow or the next day. And then if anything, if I do take a trade, I'll let you guys know. I'll make like a market recap or like a live video, something like that. But once again, that'll be it for me. Thank you guys for watching. Like, subscribe, leave a comment, and yeah, have a good day. Peace.